Howdy, welcome back to Dion Talk. Today, I would like to talk about a subject, once again, that I'm not qualified to cover. So I've reached out to my two friends, Michael Zuber from One Rental at a Time and Matt, the Lumberjack Landlord. And I would like to find out, because these are two investors that have done something that I haven't done. My entire portfolio is based on 4 units or less, so I'm strictly in residential loans. That's one of the main reasons why I stick with small multifamily is because of 30-year fixed rate, low interest rate loans. But these are two investors who've reached financial freedom through investing in real estate, and they have invested in residential properties, but they've also invested in multifamily, 5 units or more. So to start this, and you guys will have to remind me because my memory is not great, the beginning of this video, I would like to cover what prompted you to go from small multifamily to large multifamily. And then in the second half of the video, I'd like to cover, because this is the reason I'm bringing this up today, and you can hear about this in a little more detail on the One Rental at a Time YouTube channel. Fannie and Freddie recently made some changes to the way multifamily commercial loans work. And I'm definitely not qualified to cover that. I'm hoping I can understand it by the end of this video. So let's start with Matt. What was the thing that took you into commercial size real estate?
I wanted to be a big boy.
Fair enough.
Honestly, for me, it was so the thing that scared me the most was I remember when I was only singles, doubles, and tries, and it scared me the most because they were talking about all the documentation you needed and the loan was an adjustable rate loan, and all these things were super scary, frightening to me. And I just remember saying, well, if I'm going to grow the business, I can't limit myself to only one segment of the market. And so it really just came down to trying to understand a new part of the market and then looking and saying, well, okay, this is what I get for a return on a duplex. I wonder what it looks like on a 5, a 6, an 8, and a 10. And it was the ability to also scale the business faster, because every single transaction, as all of us knows, a 2 or a 10 is about the same amount of work. So I might as well go for the 10 if I can find the 10. And so that's really what the driver for me was I wanted to scale my business, grow my profit and understand a new part of the market that was different than what I was doing.
And what got you, so you got me there for a second. You were doing residential loans, 4 units or less, where they were giving you adjustable rate mortgages?
No, all of that stuff I was doing fixed rate. And in fact, all of that stuff I was also doing, I was super conservative. So my lowest down payment was 20%. So that I was super, super conservative. Everything that I bought was 20% down. And so that naturally slowed me down from being able to acquire a bunch of properties, because every time I went to go do a down payment, it wasn't a $20,000 down payment. It was a $65,000 down payment. So it took quite a bit of time, after I'd made some money doing my job and after it had been a few years and after I decided that I was going to put the money into play, that's where I got that first piece. And so for me, it helped slow me down because I was putting so much equity in, and I needed to put that much at the time. It was, 5 and 6. I needed to put that much into a lot of those deals to have them make sense. Wouldn't do that again, but that's what I had to do at the time.
Okay. And Mike, you've been investing since before the 2008 crash.
Yep. 2002 was my first. Yep.
What took you up into multifamily? I
was a residential guy for the first 5 or 6 years. And I just kept working harder and harder to try to find those deals because we were investing in an up market. I'd spent about a year or so trying to find my next deal. I think we had 6 houses and 1 duplex, and I was looking for the next house because that's all I knew. I didn't bother looking anywhere else, right? I talk about my buy box, and my buy box was really small. I didn't look up, but nothing made sense, folks. Again, watch our video on One Rental at a Time where we talk about 06. I mean, I was getting 1,100 rent for a house that was almost 300 grand. It just didn't cash flow. Basically, I went to a meetup and the presenter was talking about small multis, and we're not talking residential. This was 5s to 20s, right? So, don't ask me why 5 is different than 4. I have no idea. It just is. But he was talking about 5s to 20s. I remember talking to him, saying, I had a lot of units for that audience, right? I think we had 6 houses and a duplex. So we were the people in the audience, we were one of the bigger ones. But this guy's got, 100 or whatever he had of these smaller or bigger units. And I remember asking him, well, I hear it's harder, right? Because as a residential guy, what do you hear about commercial? It's harder, more paperwork, less friendly, right? Because it's not a bank, right? You don't really have relationships. He basically pushed those all aside. It's essentially the same paperwork. There's just more of it. The loan structure, 5, 7, 10-year fixed balloons, all of that, went over that with me. And I just remember thinking, but I'm not a millionaire, right? I just, for whatever reason, had a mental block. I assumed if I was going to own a commercial building, I had to be rich. And he just I still remember this, still irritates me that he did this. He put his arm around me and he goes, now, Michael. I'm like, you know who you're talking to. But yeah, it still bothers me. And I went home that evening and started looking. And sure enough, I still own the property that we got first on Vassar. In fact, I'm just refining it now. We bought it for $223, 5 1-1s. They're like 650, 700 square feet each. And we bought it for $223. At the time, it was $3,000 a month, I think, in rent. The house I sold was, $280 and $1,100. So I was like, well, some is good, more is better.
More is better.
So I sold every house because they didn't make sense. I had no idea it was going to crash. If you would have asked me in 2006, I would have assumed they were going up. I just knew that I couldn't buy the next one. And lo and behold, it turned out to be great timing. We went from 8 to 80 units, and I owned no houses by I don't know, mid 2006. We had no houses. Everything was apartments. And then of course the market rolls over. So I went to multifamily because it was a better deal. And frankly, single family was overpriced. That's kind of why.
That's what took me into small multifamily, is that I couldn't find single families that cash flowed at all. So I went for small multifamily. The loan structure is still kind of what stops me. So I'll ask you before we get into what's changed with Fannie and Freddie, Mike, have you ever had problems with a loan reevaluation period?
Nope.
No. Matt?
Nope.
No. Okay. So that's a fear that I have that you guys have never run into.
No, I mean, I've had, let's see. So I've probably had 30 commercial loans, maybe 35. More than half of those have come to their reset periods. I think a couple of them I had to pay for an appraisal again, which was kind of annoying, but it is what it is. I had one bank tell me they didn't lend in that market anymore. And I said, well, congratulations, I'm refining with you anyway, because you already have the loan. And we went back and forth a little bit. And because this was during the crash, I'm like, well, you've already got the paper, buddy. So went back and forth, and I played hardball and won. But yeah, no, it's been fine. The paperwork's thicker. When you see interest rate rises coming, you got to be strategic. So I actually paid points. It's the only time I can remember because you have prepayment penalties, unlike residential, like 5, 4, 3, 2, 1 or 3, 2, 1 or whatever. I paid 2 points to push out a term 7 years here recently, because I thought interest rates could be higher in 2 years and I didn't want to refi then. So you have to think about them more. It's not set it and forget it, right? My residential loans, set it, forget it, never think about it. I look at my commercial loans once a year, just to, where we are in the term. Because you do have interest rate risk. It's not set it and forget it.
One of the reasons why I kind of wanted to ask you guys this is, Mike, you have an MBA in finance, and I would like you to explain what's changed with Fannie and Freddie. And then Matt, you've been more involved in loans than I am for a long time. I want you to explain what Mike says, and then I'm going to try to explain it in layman's terms. And let's see if we can get there. So cycle down the tier of portfolio.
This ought to be great. So,
okay, Mike.
So let me just set this up. So if you've been following my channel for any length of time, you know that I believe, at least in my market, I'm buying single families because multifamily is overpriced. I have sold apartments because they are overpriced. I believe the deal structures going into these are going to blow up. And they're just dumb deal structures. So lo and behold, just in the last, 5 or 6 business days, Fannie and Freddie, who are the largest kind of participators in the commercial market, mortgage market, they have this thing called small loans. Now let's set the stage. A small multifamily loan is $7 million or less, right? That's where we're at in this discussion. And in the last 5 business days, they have come out and changed qualification for who can get the loan. They've changed who the parties can be getting the loan, because you have to have a balance sheet strong partner. There's just lots of requirements that they have now said, hey, we're going to make sure the next loans we do are better. And the only reason Fannie or Freddie would do this is because they are looking at their loan book and they must be having a growing problem of bad debt. There's a list called the hit list, basically of problem properties that are below debt service, not performing well. And that list must be growing. So when Fannie and Freddie, just like in residential a year ago, folks, most of you are residential folks. Remember when they added that 0.5% and they added this and they added that? They just did that to small portfolio loans. And I'm telling you, in 2 to 3 years, small multis, 5 to 20s, where I love to play, some of that stuff's going to blow up and I'm going to buy it cheap. And Fannie and Freddie just validated it for me because their loan book is not as solid as you want them to think, or else they wouldn't have changed it.
One of the things that I like about when you think of the concept of banking is the banks basically say, I'm sorry, we can't lend you money because you need it.
Yeah.
You have to be able to prove you're a safe bet.
Yeah.
Right.
Yeah.
Okay. And so Matt, what did you get out of what Mike just said? If you were explaining this to somebody who didn't understand finances at all, how would it sound?
So how it would sound is Fannie and Freddie are nervous. They've got some assets on their books that are $7 million or less, and there's small multifamily stuff that they're seeing not perform from a loan perspective, i.e., they're not getting paid. And they're looking at this and they're having a conversation with the owner and they say, okay, well then what can you pay? What does that look like if we restructure it? And then Fannie and Freddie are going to make the decision, you know what, we're just going to take that back from you because your proposal doesn't work. It doesn't make sense. That's not going to work for us. And they're going to then go and find somebody like a Grant Cardone or somebody that's very large and say, we want you to absorb and take over this book of, smaller multifamily loans. We want you to take this book over. And for that, we're going to basically waive any and all fees to basically get it moved over to you. And so now you've got the balance sheet, you've got the organization that can support it. You're already in those areas. And so now we're just going to basically give it to you. So now we know that we're going to get paid and you're rewarded by getting another asset. So that's what
the only slight tweak to that is absolutely what Fannie is doing today. But also what they're doing with these new tweaks I referred to is they don't want to add any more bad loans because of the risks that they found, right? Yeah. They're trying to slow down small, that's what they're doing. When they add overlays, new criteria, they're trying to slow down.
That's right.
And they're trying to keep people, they're trying to have no answers, right? That's the only thing I would add to that.
Yeah. So that's one of the things, like Mike said, what they start doing is how they naturally slow the roller coaster down is they just start adding more criteria. Okay, well, now if you want to do that, you need to be $10 million on your balance sheet.
Yep.
But last week I only needed to be 30. It's so, or 3 million. So it's the same thing, Dion, that we see on the residential side, which is a month ago, people with a 53% debt to income, somehow some of them were still getting some loans.
Yep.
And now that's in like 41 or 42% debt to income.
Exactly.
Now that's even become kind of that new threshold for a lot of those Fannie Freddie loans, or you're paying significantly more points where now still all those financial items have to qualify. So that's what I hear Mike say when he talked about the $7 million kind of smaller multifamily stuff.
One of the problems that I have when it comes to answering questions, especially when it comes to lending, when you're trying to help somebody reach financial freedom, they ask you a question about lending, is there is no answer. The same lender will have a different answer next week.
Yes.
So it's not only that the lenders are different,
yeah,
but their mindsets are different based on so many factors.
Well, I'm glad you brought that up. I try to tell everybody I can, when you're being a real estate investor, it's not a real estate cycle. There's also a lending cycle.
There is.
Lenders get greedy and nervous just like everyone else. And if you're doing yourself a disservice if you don't follow what's going on with lending. Well said, Dion.
Okay, so now I'm going to give Matt a chance to tell me that I'm wrong. But not today. The layman's explanation of what you guys just talked about, and I'm going to go right back to a few seconds ago when you said there are cycles, Mike.
Okay.
Lending cycles, market cycles. It seems like understanding the cycles is the best way to prepare for what's going to be coming. and knowing that at some point it makes sense to buy single family houses, because in the area that I'm at, there's a ton of single family rentals that make sense to the owner who bought them when they did. When I started investing, they don't cash flow, and they haven't for over 10 years. Small multifamily makes sense to me now, but there might come a point where if the affordability index drops low enough to where it's the time to sell because everybody's willing to overpay, to take that money and roll it into something bigger. But unless you're doing the work and studying the markets and learning the cycles and taking the time to learn what half the acronyms you guys used in the last 10 minutes mean, you won't be ready. Because the goal is to have the ability to be ready for opportunity, because when you are prepared for an opportunity, you get to be Mike's favorite word, lucky.
No! Oh, that's a hot button. Don't touch that rail.
One thing I've learned is never give people your hot buttons, because they'll just push them. Right. All right. Well, I want to thank you both for coming on here today and explaining a concept that I understand better now, but I will probably reach out with questions. If people listening have questions, how can they find you, Matt?
Lumberjacklandlord.com and Lumberjack Landlord on YouTube, and Thursdays with the dynamic duo. You guys.
You say dynamic duo, but this is my favorite threesome. And how can people find you? Follow that.
Go to your Google search bar and type in one rental at a time. Just for you.
Well, thank you both. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.